Okay, now let's look at a comparison of the different life insurance product, the term, the whole life, endowment, and investment-linked plans. The key objective of a term plan is for protection only. For whole life and endowment, they are considered a bundled insurance product because other than protection, it also offers policyholders a potential to invest their savings. And for ILP, similarly, it also offers protection as well as the potential to reap some investment returns. On the scope of coverage, most plans will cover death and total permanent disability, and some even with the option to attach riders to enhance their benefits. For the payment schedule, it may vary across a product as well as across different insurers. On the element to invest your savings, there is none in term. As mentioned, it only covers protection. It does not provide you with any cash value. For whole life and endowment, there is a guaranteed cash value. At the same time, companies may also declare a bonus every year. However, these are only projected values which are non-guaranteed and is subject to change depending on the economic condition as well as depend on the profitability of the insurance fund. For ILP, the returns are not guaranteed at all. The value of your portfolio would depend on the investment performance or the market performance of the underlying fund of your portfolio. So you are subjected to investment risks. In terms of cost, the term policy will cost the least and it will be more expensive if you are getting bundled products. So if your objective is just to provide your family with the protection, then you may want to consider term. On health insurance is an insurance that protects your family from suffering a financial loss as a result of an accident, illness, or disability. At the same time, it may also provide you an income while you are disabled or in the hospital, and also covering the cost of medical or nursing care. Assessing your insurance needs, there are several factors where the risks are insurable, such as the death, a premature death, total permanent disability, partial disability, financial loss in the result of long hospital stay, and as well as financial loss that occur due to a critical illness. And how do you assess how much insurance you need? The decision on the type of insurance and as well as the amount of insurance you need will depend on many factors. First is your budget. What is your budget constraint? Do you have the budget to get an expensive product? And next is how many dependents do you have? Who are they and how old are they? Is your income going to support your parents or your children? How long would your children be financially independent? And that will determine how long you need to protect your income. What is the standard of living you want to provide for them? If you want to provide a higher standard of living, naturally you will need to have a higher amount of coverage. Or would you like to just cover them with the basic cost of living? How about debts and liabilities? Do you have any outstanding debts or liabilities? Debts and your other obligations remain a debt whether you are around or not. So if you do not have a coverage to provide to cover these debts, you are simply passing these obligations to your family members when you're no longer around. How about children's education? Have you provided your children with the cost of education? And over here, we are not just simply talking about tertiary education. It's the ongoing expenses that a child will need during the schooling days, such as cost of enrichment classes, tuition, etc., etc. And how about any existing savings or investment you have that you can at the same time use to provide that your family can actually use in an event you're no longer around. There are actually 5 steps to determine your insurance need. First of all, establish the goals of buying insurance. What is the purpose of buying the insurance? Is it for protection or is it to save for your child's education? Then you estimate the amounts of funds needed. Say, for example, if you are going to provide for your child's tertiary education, how much does it cost for the education fees today? And factoring in inflation, assuming you need your education funds to be ready in 10 years' time, with the inflation of about 4% for tertiary education, the amount that will help you work out the amount that you need 10 years later. After that, you identify your resources available, such as do you have any existing savings that can also go into this financial objective. After that, that is where you can estimate the amount of insurance you need by taking away the amount of resources available from the amount of funds you need. And finally, you choose and design an insurance policy to meet your goals. In selecting the type of insurance, we have here some examples of how people, or some of the strategies of insurance. Like, for example, if you're worried of death and total permanent disability, then you may want to consider term insurance or life insurance. And because such insurance will provide you with an instant amount of money for your family should something happens to you. And for the death, if you want to cover your outstanding home loan, you may want to consider a term mortgage reducing term insurance. It is a form of life insurance that will offset the outstanding amount of loan that you have. And it helps to pay off your mortgage in an event the mortgagor passes on. And in selecting the type of health insurance, if you're worried about critical illness, then the health insurance, there are various schemes available in the market. It basically provides you with a lump sum of money upon either the first diagnosis of the serious illness or upon certain conditions that have set in. And if you want to cover your medical bills or major illness or accident, then you could consider MediShield, the Integrated Shield Plan, and other hospital and medical plans. Such plans pays a portion of the hospital and surgical costs if you are ill or suffering from injuries due to an accident. You can also cover loss of income if you're hospitalized, and such plans we commonly call them the Hospital Income Protection Plan. So it basically provides you with the daily income each day you are in the hospital.